How much tax is taken off my pension? It is the question that keeps so many of you up at night, staring at the ceiling, wondering if the money you worked 40 years to save is going to vanish right into the hands of the IRS the minute you retire. You are afraid. You are worried that you won't have enough to pay your monthly bills, keep your home, or live the life of dignity that you deserve. I get it. But we need to stand in our truth right now. Fear comes from what you do not know. The moment you understand exactly how your pension is taxed, you take your power back. So let's strip away the confusion and look at the absolute reality of your money. First, let's address the big misunderstanding. A lot of you think that because a pension is retirement money, it's somehow tax-free or gets special, lower tax rates. It does not. The IRS views your corporate or government pension as ordinary income. What does that mean? It means every single dollar you receive from that pension check is treated exactly like the regular salary or hourly wages you earned when you were waking up at 5 in the morning to go to work. If you paid into your pension with pre-tax dollars, which is how 95% of traditional pensions are set up, then every penny that leaves that fund and enters your bank account is fully taxable at ordinary federal income tax rates. And it's not just federal taxes. You have to look at where you live. Some states are incredibly friendly to retirees and won't touch your pension at all. Other states will tax every single cent of it. You need to know the laws of your state because ignoring state tax can completely wreck your monthly budget. Now, let's talk about how the money actually gets taken out, because this is where so many retirees get blindsided. When you are working, your employer automatically tips taxes out of your paycheck. When you retire, the administrator of your pension plan is required by federal law to withhold income tax from your pension payments. By default, if you don't tell them otherwise, they will often withhold taxes as if you are a married individual claiming 3 withholding allowances. Here is the problem with that: their default guess might be completely wrong for your actual financial life. If they withhold too little, you are going to get a massive, shocking tax bill when you file your return next April, plus potential penalties for underpayment. If they withhold too much, you are giving the government a direct, interest-free loan while you are struggling to pay for your groceries and your healthcare right now. You cannot afford to let a computer program at a pension office guess how much money you need to live on. To determine your true tax hit, you have to look at your total income picture. Your pension does not live in a vacuum. You might have Social Security benefits. You might have traditional 401k or IRA distributions. You might have a little part-time job or investment income. All of that gets thrown into one big pot called your adjusted gross income. Once that total income is figured out, the IRS applies your standard deduction. For a married couple filing jointly, that standard deduction blocks out a huge chunk of your income from being taxed at all. And remember, if you are age 65 or older, you get an extra senior deduction on top of the basic standard deduction. That is a beautiful cushion that protects your hard-earned money. But whatever income is left over after deductions gets hit by the federal tax brackets. It starts at 10%, then moves to 12%, 22%, 24%, and goes up from there. The tax is progressive. Only the income within a specific bracket is taxed at that rate. But if your pension plus your Social Security pushes you into a higher bracket, every dollar in that higher tier is losing nearly a quarter of its value to federal taxes alone. And let's address the hidden trap that nobody warns you about, the Social Security tax torpedo. If your pension income is substantial, it can trigger taxation on your Social Security benefits. If your combined income, which is your adjusted gross income plus half of your Social Security, crosses a certain threshold, up to 85% of your Social Security benefits suddenly become subject to income tax. It is a double tax hit that catches retirees completely off guard, turning a comfortable retirement into a financial squeeze. So, what is the actionable takeaway here? How do you stop the bleeding and protect your peace of mind? You must take control of IRS Form W-4P. That is the withholding certificate for pension or annuity payments. You do not have to accept the default withholding that your pension company hands you. You have the absolute right to log into your pension portal or call your plan administrator and demand a new W-4P form. Do the math or sit down with a qualified tax professional. Calculate your total expected income for the year, figure out your exact tax bracket, and tell your pension administrator precisely how much to withhold. If you want them to take out a specific percentage or an exact dollar amount every single month so that your tax liability is covered, you can write that directly on the form. By aligning your pension withholding with your true tax reality, you eliminate the fear of a surprise tax bill, you maximize the cash flowing into your bank account every month, and you ensure that you are the one controlling your money, not the IRS. Do not wait until next April to fix this. Call your pension provider, adjust your withholding, and secure your financial future today.